Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 345th VideoCast podcast for the week ending May 28th, 2026. Got a lot of great stuff to cover today, but as always, family first, then we'll get down to business. We had exciting news. Mimi has been named to the 2026 USA Water Polo Development National Team. The tryout process began back in October. She made it through 4 elimination rounds of camps and tournaments to make the team, and we are so proud of her. This has been her dream since she started playing water polo 3 years ago, and we are so happy to see her dreams coming true. It was also a big weekend for Annabelle. She was featured in Swim Swam 3 days in a row for her wins at the 2026 Speedo Grand Challenge. And she also had her first post-race interview for being 11 and swimming the fastest 50-meter freestyle in the nation among even 12-year-olds. Have to say thank you to Swim Swam, as they are so supportive of Annabelle. We really appreciate that they acknowledge her and take the time to cover her accomplishments. So, some pictures here. There's we were celebrating at Joey in Newport for her making the national camp. Here's some of the Swim Swam. You can go to swimswam.com and support them. Annabelle Hayes of Irvine Nova Aquatics continued to deliver top performances, throwing down a personal best time of 28:05 in the girls 7:12:50 free to win the event and top the national rankings. The 11-year-old's performance marked the fastest time in the country so far this season for the 11 and 12-year-old age group. So awesome stuff there. I want to thank our friends Daryl and Serena. We got to join them in Vegas at the Wynn. We flew out for a day to see Sebastian Maniscalco. I got to say, this guy, in terms of laugh per dollar, is unmatched. I mean, I never laughed so hard for literally 90 minutes straight. This guy was absolutely phenomenal. And when you're at the Encore, go to Mizumi if you like Japanese food. I usually think Wagyu is kind of a promote, but the Wagyu at this place was off the charts. So check it out. What else do we have here? There's Annabelle getting her medal. One of them, another one, more Swim Swam. And there's Mimi getting on that National Olympic Development. So excited for her as well. Then Annabelle had her first live interview. So there we go. Let's watch her get her medal.
Annabelle, is that your second win this week? Fourth win of this meet.
Yes.
What motivates you?
I just give my all, I work hard, and I just push myself to max.
Congratulations, you're maxed out tonight. Good job. Congratulations.
Work hard and push myself to the max. Love that. Absolutely incredible. And then had the privilege to join Yahoo Finance. Thank Brian Sazi, Brooke DePalma, Inez Ferre, Justin Oliver for joining. Before I do that, I also want to thank Jason Seltzer for having me up to play Hillcrest Country Club in Los Angeles. He saw me on Fox Business last week and liked a couple of things I had to say. That was just an incredible experience. And by the way, for the first time in a while, I booked a 39 on the front, which was pretty awesome for playing the course for the first time, and then obviously blew up on the back, or we would have better news to share. But that said, let's go to Yahoo and look at market outlook.
Your investing day is underway with green on the screen on hopes the Iran deal gets officially inked, so oil prices could pull back further, hopefully at some point this summer, who knows. Stocks have enjoyed 8 straight weeks of gains. Memory chips like Micron and SanDisk, those stocks look unstoppable, and Wall Street keeps jacking up their 2026 profit estimates. But allow me to be the calm person in a frenzied room. I know calm and, doesn't really fit with me, but nonetheless, I'm going to try to do it. Stocks are getting really expensive as everyone enjoys this market melt up. The Shiller cyclically adjusted price to earnings ratio for the S&P 500 has risen to 40%. 38.8. The only other time this ratio has exceeded 40 in 145 years of data was in the year surrounding the peak of the 2000 dot-com bubble when it briefly touched 44. Clearly, investors are piling into stocks at a feverish pace, but by another measure, stocks look as unattractive as they did after the aforementioned dot-com burst. Hat tip to WSJ for pointing this one out this morning in a story. The metric is known as the equity risk premium. It's often defined as the gap between the S&P 500's earnings yield, the profit companies generate relative to stock valuations, expressed as a percentage, and that of the 10-year Treasury note. In recent weeks, the gap has nearly disappeared, vanished, and is hovering among its lowest levels since the start of the new millennium. Should we be terrified of this valuation levels across the board? Here on the OP Roundtable to weigh in, Thomas Hayes, Great Hill Capital Chairman and Managing Member, alongside Yahoo Finance Senior Reporters Book Prama and Frey. Tom, I mean, should we care about these stock valuations?
I think we should. I think the key here is to be fearful when others are greedy. That doesn't mean we're bearish on the stock market at all. We are cautious on certain parts of the market that have absolutely run away, whether it's memory, whether it's semiconductors. And you'll notice that they've gone parabolic in the last 4 to 8 weeks as inflation expectations have risen as a result of elevated oil prices, as a result of the Iran war. If we do get some resolution here in coming days or weeks, I think you're going to see a violent rotation out of these stocks and back into the everything trade that we began the year with before the Iran war. If you remember, low volatility stocks were running, defensives were running, staples were running, industrials were running. Everything was running, and then in the last 4 to 8 weeks, the only thing that worked was the AI trade and semiconductors. And look, Brian, you've been around as long as I have. You don't have to look further than a micron chart to see every 4 years for the last 30 years is the exact same story. Shortage, build capacity just in time for demand to wane, stock goes down. So right now, people are buying the peaks. You're seeing it in retail call buying at record levels not seen since the meme days of late 2021, right before tech cooled off. Even institutional equity exposure is the highest since January 2022. That was not when you wanted to be buying equities. So a dose of caution, or at least rotation, even though we're not technically bearish and we're mostly invested, we do have some hedges on for the first time in some time.
Tom, the bulls will get at me on X and say, Brian, you're a straight dumbass. You were telling me a month and a half ago that stocks were richly valued, and now they've gotten even more richly valued. I guess the point I'm trying to make, Tom, is can stocks get even more expensive?
Of course. They absolutely can. But here's the thing. When you're gambling and chasing the shiny objects, sooner or later, the casino wins. So can they go up another 20% before correcting 40 or 50%? Some of these stocks that have run very aggressively in the last 4 to 8 weeks, of course. And these are the same people who are sliding into your DM right now and giving you a lot of trouble, who are going to absolutely disappear in the next 4 to 8 weeks when those stocks come in, and you'll never hear from them again. And then they'll be back up on the next cycle when the next hot meme thing is going, and they're saying, Brian, that's why you're a journalist and we're traders, and then their account just deactivates after 6 months when they blow up their account.
Yeah, F them.
Same as ever.
Yeah, Inez, speaking of shiny objects, I mean, I woke this morning, it seems like another typical day here in the markets. Everyone loves Micron, everyone loves SanDisk, and now all that love is being put on various quantum stocks. It started late last week, but it's continuing here this morning. Brooke, good morning to you. Hit me with something epic.
I mean, what we heard from Raymond James is that if this deal does happen, as sort of Tom was alluding to, we will see some rotation happening. This Raymond James note pointing out that AI, as Tom and Inez are all talking about, it's a separate soap opera going on right now. That's the way that Raymond James phrased it this morning. And according to this note, we'll see a big rotation into the cyclical sectors like industrials, like financials, like consumer discretionary. And they said that we will see some weakness, and where we have seen investors turn to like energy and defensive areas like healthcare, staples, real estate, and utilities. And this comes at an interesting time because we have seen a lot of momentum within healthcare. Specifically, I was talking to one UBS expert just last week, and with Eli Lilly booming with those GLP-1 drugs, I think that's definitely one to watch as well.
Tom, I'm trying to think what pops this stock bubble, and I just think this is a market not really grasping what new Fed Chair Kevin Warsh has in the cards.
Yeah, look, I wouldn't call this a stock market bubble. I would call it perhaps a trade, a specific sector trade bubble, the AI trade, et cetera. A lot of commonality since from the 2000 top. If you recall, the covers of Warren Buffett, has Warren Buffett lost his touch? He was buying defensive stocks. He was buying staples when tech got really accelerated on the internet hype. And over the next 3 years, as the NASDAQ fell 80%, he had 3 of his best years of performance ever, 2001, 2002, 2003, while everyone was losing 80% in their NASDAQ trades. The other thing to keep in mind, a similarity to 2000, healthcare and consumer stocks relative performance to the S&P 500 is at the lowest level since that 2000 peak, and I think we're going to get an aggressive reversion to the mean. Managers are overweight tech, they're underweight staples, and I think the Raymond James note that Brooke referenced is spot on. So I could see a scenario where these stocks take a breather, everything else rallies, indices are somewhat flat to down. But look, when you have a new Fed chair, the average correction in the first 3 or 4 months since 1930 is 12%. In a midterm election year, which we are in right now, the average midterm correction intra-year is about 17%. I'm not calling for those. I think we've pulled forward a lot of that with 20% corrections in the last 6 years, when it usually happens once every 3.5 years, but I do think we could see an 8 to 10% pullback led by the semiconductor AI trade, while at the same time these underweight sectors, low volatility stocks, consumer stocks, healthcare, defensives actually get bid, and you don't see it in the indices. So I think we're in for an exciting time in the next 3 months. If you don't have anything outside the AI trade, maybe lighten up and get some exposure to the rest of the market. But I'm not calling for any type of bubble burst or anything like that, because underlying earnings, underlying economy is still pretty strong. And if they can get this Iran thing tied up pretty quickly, we don't run the risk of running it into a wall, which I think if you hold oil prices this high for another couple of 2-3 months, you could certainly tip into a recession that doesn't have to be in the cards.
Brooke, speaking of recession, it is amazing to see. This industry has always seen major booms and busts, but at least for the next 2 years, it looks like these companies, SanDisk, Micron, you name it, have license to print money.
Yeah, listen, the ETF just in time, it's called Opinion Follows Trend. Like a true stock market geek, I spent the weekend looking at all these Momo stocks that have just gone parabolic. And I actually burdened myself with the facts, looking at revenues, looking at free cash flow. And all I can tell you is we've had multiple expansion, but we haven't had cash generation expansion for the most part, or certainly not greater than prior peaks right before you got to increased capacity and or workarounds as Inez referenced. I'd be very, very cautious in this area. The other thing that I'd keep in mind is defensives, healthcare, staples, utilities, etc. Weighting in the S&P 500 is the lowest it's been since the tech peak in 2000. It's dropped from 35% weighting in the S&P, those groups, down to 16%. This is what we call, buy opportunities like this happen once every 25 years. We are in one of those. So while everyone's chasing the latest ETF with these momentum stocks, which capacity is going to come on and they're going to come down, whether they go up another 20% before they collapse 50 or 60%, we don't know that. Can't predict it. We can avoid it, put it in the too hard box, as Warren Buffett would say, and buy what's on sale, buy durable, free cash flowing companies with predictability, and get your doubles and triples over a few years and avoid the boom bust shiny object chasing methodologies.
Brooke, at its most basic, All right, let's keep it moving here. Madison Square Garden shares are scoring some points following Knicks' sweep of the Cleveland Cavaliers late Monday. The win will see the Knicks headed to the NBA Finals for the first time since 1999. I wanted to take a brief trip down memory lane for you all. The Knicks' return to the Finals has an eerie feeling from a stock market perspective to the playoff battle against the arch-rival Indiana Pacers in 1999, which led to them facing the San Antonio Spurs in the finals. Right as the Knicks were dueling the Reggie Miller-led Pacers in the Eastern Conference Finals in May 1999, eToys.com went public. In a classic sign of the tech bubble times, the stock debuted at $28, skyrocketed to $76 on its first day, and instantly commanded a $7.7 billion valuation, making the loss-generating website worth more than then bricks-and-mortar toy giant Toys R Us, which of course now is bankrupt. Hype, eyeballs, and mindshare were completely replacing traditional metrics like profit or cash flow late in 1999. As we know, it all literally came crashing down months later in the dot-com bust. Today, the Knicks entered the NBA Finals amidst the AI boom that has seen shares of Micron, SanDisk, and Palantir trading at nosebleed seat valuations. Similar to the dot-com hype, investors are readying for splashy IPOs this year of SpaceX and OpenAI, two tech beasts also not making any money anytime soon. Just want to put all this out there. My question is this: what's the best way to play the Knicks' upcoming ride through the finals? Tom, coming to you here, how could you do this from a sports perspective? If you are bullish on the Knicks, everything they represent, is there a way to play this?
You could play MSG Entertainment. Look, I've been doing this for a while. By the time something is in the headlines, you're already too late. I mean, the fact that everyone wants to talk about buying the Knicks today after they already made the finals, it's like buy the rumor, sell the news. I would be kind of avoiding it. Look, sports team valuations have gone from high to higher to highest, and there's no telling when the liquidity evaporates. What we should try to focus on here, Brian, is buying what's out of favor, and when they finally do get in the headlines, like the Knicks are right now, like semiconductors, like DRAM and the latest ETF, and that's creating liquidity for us to get out from having bought it when no one else wanted it. So I would say the best way to enjoy the sports trade is to make some popcorn, sit on the couch, and watch the Knicks win.
In other words, you should have bought MSGS in 2018 when everybody hated the Knicks. Brooke, I know you're watching the Poly Market odds.
And we're back. And quotes of the week: the four most dangerous words in investing is, quote, "This time is different." That's from Sir John Templeton. We're going to talk a little bit about that. And Robert Arnott: in investing, what is comfortable is rarely profitable. You know, we're seeing that a glimpse of that today. And I always talk about when these things come, they come all at once. You know, Hormel Foods has been a dog, but it's paid us a 6% dividend while we're waiting. They keep increasing the dividend, and we know through our framework that in the short term, the market's a voting machine. Defensives were out of favor. In the long term, it's a weighing machine based on fundamentals. Today was the beginning of the turnaround. Stock's up 9 or 10%, and just the beginning. And when they come all at once. And if the framework is correct, sooner or later, they all get bid up. And you've seen it over the years. The ones that you give up on, that we never do because we do our work and we know where we're getting out before we get in. Shortly thereafter, they just go parabolic, and as Jensen Huang would like to say. So that's that. I want to thank everyone who's been sharing about our great work here at Hedge Fund Tips with Tom Hayes. That's all we ask. We originally set this up as a way to keep our clients up to date on portfolio positions, and then we let the general public listen in. And some of you, quite a few of you, by the way, we had the most amount of new clients come in the history of the firm in the last week. Everyone's trying to get in at the $1 million level before the SEC rule changes and pushes it up to 1.5 million on January 1st. So if you took advantage of that, congratulations, you'll be grandfathered in. We are grateful to have everyone on board, and the timing is just perfect. As rocky as this has been, it's interesting. The first 2 months of the year, we were shooting the lights out because the everything trade was working, and then this war came out of nowhere, and only one trade has been working, and now this war is getting resolved. So I'm super duper excited for everyone that's come in since the beginning of this year, because I think as this gets wound down and it looks like they're going to get a deal signed by the end of the week, we're going to see that everything trade come back and be, smiling so wide we could eat 5 banana sideways, just as we were in the first 2 months before this surprise war came out of nowhere and forced everyone into only those trades that could work in a high inflation, slow growth environment. And when the war is removed and inflation expectations come down and yields come down, as we talked about on Yahoo, we're going to see a violent move into the everything trade where we were just crushing the first 2 months of the year, and that crushing is going to come back in spades for new, existing, and everyone, which we're super duper excited about. But what we say is, here's the deal. We open this up for people. Many of you will become clients. The ones that can afford, pretty much all of you will become clients. The ones who can't, we want to still give you value. So all we ask is that you share this with one person that you care about that would benefit from this work. And you have been doing that. And for that, we're grateful. Also, and that's what keeps this thing going. And we're going to do this for many more years. 345 episodes every single week without fail. Very few people have done that. That's almost 7 consecutive years. And you guys make me want to keep doing that because you're doing your part. The other thing that happened is there was one lady, you can look in the comments every week for the last 6 weeks, has been saying, when are you going to do a t-shirt with your face on it? And I keep saying, never. I would not only never do it, never wear it. It's the most ridiculous thing I've ever heard. She keeps doing it. And friends reminded me that the customer is always right. So my assistant did this. I haven't ordered one, so I don't know if it's going to be good. I would strongly urge none of you to buy this, but if this lady wants one, you can now get one because the customer is always right. Now, for everyone else, one of the easiest ways and why we did this to share about the podcast, if you're shy, wear the hat, use the incredible mugs. People will ask you, share it with one person, and we can do it another 7 years because you're doing your part. Also want to acknowledge the folks that are sending in pictures. Dan and Kathleen this week, looking incredible in front of, in Greece here with your hats on, and obviously Mark and Seth and Jess and Mac and Guglielmo and et cetera, et cetera. So please not only order this stuff to share the podcast and keep this incredibly positive cycle going, but send in your pictures so everyone can see the community and be part of it. Very, very grateful for that. All right, let's get down to business. First and foremost, I wanted to talk about some of the similarities between now and the 2000 tech peak. I think there are some similarities. I think there are a lot of differences, but we referenced it multiple times. And here's the new headline on Benzinga. Is Warren Buffett's playbook losing its edge? Berkshire Hathaway lags the S&P 500 by the most since 2008. So it says for years, Berkshire Hathaway was the stock investor where they went when they got nervous. It's fallen sharply, making it one of its deepest relative slumps since the run-up to the 2008 financial crisis, losing ground against the broader market. You could see here Berkshire Hathaway significantly underperformed the S&P 500 during the dot-com bubble of 1999 and 2000, driven by a surge in tech stocks. The S&P 500 posted double-digit gains. In contrast, Berkshire's value dropped as it avoided overvalued internet companies, resulting in a historically poor showing. In 1999, Berkshire Hathaway stock fell nearly 23%. Despite book value growing 0.5%, in the S&P was up 21%. So that was an underperformance by over 40 percentage points. Buffett famously graded his 1999 capital allocation with a D in his letter to shareholders. Similar thing in the beginning of 2000, and then as all the people that were outperforming from tech stocks lost 80% of their money in the tech wreck. He had 3 of his best years. Because why? What was he buying when everyone was chasing these things up 5 and 10x? He was buying defensives like Procter & Gamble, like Coca-Cola. And for the next 3 years, he had among his best 3 years of performance, while most people lost 80% of their money in the high-flying stocks that went bust. I don't think it's going to be that extreme, but it's normal during these turning points when maybe the overheated stuff are getting ready for a break. Let's take a look at retail options traders. They've traded roughly 2.8 times their average daily semiconductor volume this month, nearly 25% above the prior record set in June 2024. Activity skyrocketing. So, these are not, you see the spikes in 2021. These are not, when retail is aggressively using leverage in one particular overheated area, like GameStop, like AMC, it can go higher than you think for longer than you think, but sooner or later, the casino always wins and takes all the gamblers' money. And this time will be no different. So I'm not saying this is going to be the exact same thing. History doesn't repeat, but it does rhyme. Here are some charts that were on Twitter. I guess it's from TradingView is the source. You can see here right now, Intel at 100 PE. During the .com bubble, it peaked out at a 50 PE. AMD at 153 times PE. We don't have that. We don't have it from the previous time. And you can see these going parabolic, making similar patterns, etc. Again, it doesn't mean that they're going to crash. We understand the secular story that people are purveying. They had the same secular story in 1999 and 2000. Just ask Global Crossing and WorldCom and all the others that thought it was going to last forever. And this time it was different. And we were at a permanently high plateau, just like we heard in 1929. I think the difference is the underlying economy is exceptionally strong. A lot of companies are doing well. I think productivity is going to increase. I think it will be disinflationary. I think all those things are true. I think that, like Amazon in 1999 and 2000, AI is going to change the world. The problem is you may be paying as if the world has already changed and you're paying for what's going to happen 10 years from now today. And when that happens, like Amazon, the greatest company in the world, the next year it fell 90%, even though revenues, earnings, and cash flow all went up in 2001, in 2002, in 2003. By the way, not only did Amazon do everything that they promised they were going to do, they did a lot more than they promised they were going to do. It's just you were paying far too much for it back in 2000, and you had to wait some 10 years to get back to even. And then, of course, you made money over time because they did change the world. But that's an awful long time to have dead money and a negative 80% mark to market, and I wouldn't advise it. So, like we took profits on Intel at 96.97. Yeah, that's a huge move. Did it go to 130? Yeah, now it's back to 114. My guess is it goes back to 60 before it goes to 200, but we shall see. We've got some Slumer insights here. You can see yields backing off on the expectation of a Iran deal. We started to see everything move up yesterday in size. Today, some follow through in that trade, which was good. Yesterday, it was everything up and semiconductors down. Today is everything up, mostly a little mixed because Trump hasn't signed the deal. You're seeing the kind of resistance levels here. S&P equal weight breaking out. That's positive. Hasn't had the same move as cap weight. I think that's going to flip in coming months, where equal weight will do better than cap weighted, which is basically the same as the technology sector. ETF. Healthcare starting to bounce off of this support level. that is in line with how we see things shaking out, just like we saw earlier in the year before the war came out of nowhere. Stocks can have trouble with new Fed leadership. The average drawdown in the first few months after a new Fed chair since 1930 is 12%. The median is 7.9. That's from Carson. Here is momentum versus minimum volatility. So effectively high beta, the AI trade versus the everything trade and defensives. It is a 5 standard deviation overshoot. The last time you have seen overshoots like this with the Momo stocks and absolute gambling was 2021 before the tech crash in 2022. June 2008 before the great financial crisis, and March of 2000 before the tech bubble rolled over. So if you are over concentrated in the shiny object stocks because you think NVIDIA is trading at 3 times or 9 times, it's not 9 times normalized earnings. It's 9 times fantasy next year secular earnings that are never secular. They're always cyclical. So you're probably trading at 100 times trough earnings. You just don't know that because you're not going to see trough earnings for another 24 months. But you'll understand what I'm talking about when the markdown is 80%. S&P 500 equity risk premium. Again, this is led by those particular sectors that have gotten ahead of themselves. JPM, U.S. low vol basket, and 10-year bond yield. So, as we were saying, we're up until the war, it just was going straight up the low vol basket. Since the war, it's been weak, and as the war ends, I think we're going to see really renewed strength in that, and see 8 or 10 stocks start to gallop like Hormel and others. AI powers momentum's best run on record. Again, you got to go all the way back to the January 2000, right before you lost 80% of your money, to see anything like this. AI whales, AI and Anthropic spending commitments to the 4 biggest cloud providers as a percentage of those providers' revenue backlog. And what people are clearly saying is, where's the money coming from, especially as the hyperscalers move towards negative free cash flow. How are they going to fund the $1 trillion of CapEx commitments? And the answer was the debt markets. Yields are going up. Will they continue to get unlimited financing in the debt markets? We're going to find out in coming weeks. My guess is in Q2 earnings, which will start in September in earnest for tech companies, you're going to see hyperscalers start to back off on CapEx commitments. And that's where the AI trade is going to short-term crash, AKA, some of these names that are up 5X are going to be down 50, 60%. And that'll be your last chance to buy them, because I think we're kind of in the 4th or 5th inning of the AI revolution. And there'll be huge opportunity to make money buying them in the hole, just like we bought Amazon and Google at 50% off in fall of 2022 when you couldn't give them away. So here's the semiconductor index has gotten to 22% of the S&P 500 weight. That's insane. Schiller PEs now at levels you haven't seen since the beginning of 2000. And before then, you got to go back to, so March 2000 is the last time you saw a Schiller PE like this. Then you got to go back to 1929. So that's concentrated in one area, which has become an aggressive weight. Do not be surprised if that area takes a breather later this year or sooner. Here's a letter from Chairman and CEO of Alibaba. Alibaba Group enters a new phase of entrepreneurial innovation and critical investments for the future. Our strategic positioning, competitive strengths, and how we intend to capture the next wave of growth. We expect the addressable market for companies like Alibaba that provide full-stack AI capabilities is poised to grow exponentially. Against this backdrop, Alibaba AI has moved beyond the initial investment phase and entered the full-scale commercialization. Driven by robust AI demand, our Cloud Intelligence Group's external revenue growth accelerated to 40% in the final quarter of fiscal 26, with AI-related products accounting for 30% of this revenue, which, by the way, grew triple digits for the last 12 quarters consecutively per quarter. This reflects AI's role in driving a comprehensive upgrade of Alibaba's cloud entire business, and its growth engine fully pivots from traditional compute and storage to models, AI compute, and agent services. Our proprietary T-Head AI chips have achieved production at scale, delivering high-performance compute capacity to our cloud infrastructure and model as a service inference platform, releasing 3 updates to Quen's family within the past 3 months. In November 25, we launched the Quen app, our all-in-one personal AI assistant for life, work, and learning, deeply integrated across our ecosystem, including Taobao, Tmall, Taobao Instant Commerce, Fliggy, Demai, AMAP, Alipay. The app serves distinctive capabilities spanning everyday life, services, productivity, and entertainment. Together, they complete our comprehensive AI application strategy across both enterprise and consumer users. AI's leading full-stack capabilities across the AI value chain put us in a strategically advantaged position in the new world of AI. With our talent, technology, and resources, we are confident in seizing the moment to propel AI and cloud into another growth engine for Alibaba. To realize this vision, we're scaling up our investments in our full-stack AI capabilities. We are seeing an enormous opportunity to capture market value in this space, aka market share. In the consumer sector, quick commerce has become a core strategic pillar in the ongoing platform transformation of Taobao and Tmall. With over 1.1 billion internet users, China is the world's largest online retail market. As our e-commerce business grew its roots from this dynamic and vast market environment, Taobao and Tmall will remain focused on user growth and improving user experience, increasing transactions, monetization. Alibaba must maintain our growth mindset, embracing change, investing patiently in our capabilities, and securing our future through long-term thinking. This is who we are. And they're the cheapest AI play in the world with the greatest upside, in our opinion. Healthcare versus S&P 500. We've talked about this. This was the period where you got the Buffett headlines, where he was buying defensive stocks. You couldn't give them away. And for the next 3+ years, they dramatically outperformed. This time, in our view, will be no different, and we are positioned accordingly. Average forward 12-month total returns. I mean, look, when I talk about generational buy opportunity, this is what I'm talking about, and generation means it comes around once every 25 years. So we haven't seen this relative price performance. The weightings of these defensive sectors drop from 35 down to 16. You will see a mean reversion there. By the way, just want to shout out Jennifer, my assistant. She, I didn't reference, she actually got a bunch more mugs. Okay, so we now have, if you go to hedgefundtips.com, click on the picture of the hat here on the right-hand side. By the way, when you're there, click on terms. This is all opinion, not advice. You will find some exciting stuff. We've got new mugs. So there's one that says hedge fund tips on the front, and it says, "You'll be smiling so wide you could eat a banana sideways" on the back. So that's a banana sideways one. Then you got a hedge fund tips mug that says, these are all our famous quotes. They don't give away multi-baggers for free. So hedge fund tips on the front. Just as a reminder, they don't give away multi-baggers for free. You're going to go through a little bit of pain before you get the reward. Be greedy when others are fearful. We continue to remind that. And be fearful when others are greedy. Maybe that's another one that we have to put up there. Next one she did is hedge fund tips on the front. Short-term voting machine, long-term weighing machine. So check that one out. And then my favorite is the key here. Hedge fund tips on the front, opinion follows trend on the back. So she's going to be putting up. All right. Now, this is just for that lady. Please, no one order this shirt. This is the ugliest, most ridiculous thing ever. She wanted a picture of me. This is embroidered, so I don't even know if the picture is going to be good. On the front, it has a picture, ugly picture of me. It says Hedge Fund Tips with Tom Hayes. And on the back, it says Turn Around Tom. A little bit of a pun there. I think that's kind of funny. But, you know, wear it to a Halloween costume if you want to party, if you want to scare people. I would not recommend that one. Then we got a mug that says price is what you pay, value is what you get, and so on and so forth. So we'll continue to add stuff there. My guess is this ugly turnaround Tom with my head shot will be discontinued very, very shortly. But for that one lady who asked 5 weeks in a row, have at it. We love and appreciate your support, but not one I would wear. All right, moving on to the next. Average S&P forward 12-month total returns. When you have the highest consumer sentiment, you get very low forward returns. When you have the lowest consumer sentiment, which is right now, you get the highest forward returns. So that's reason to be bullish on the everything trade in our view. I don't think it's reason to be bullish right now on the AI trade, which worked because of this exogenous man-made created war that changed what people could invest in on the basis of if high oil prices persisted, high inflation expectations would persist, which means high yields would persist, which means the economy would slow down, which means only that trade could work. Nothing cyclical or real businesses will work because you'd be moving into a recession, man-made recession. Now that it looks like this is going to get alleviated in the next few days or a week or whatever, we'll get back to smiling so wide we could eat 5 bananas sideways like we were the first 2 months of this year. Equal weight consumer stocks versus S&P 500 below great financial crisis lows, which, you know, basically shows what we've been talking about, which nothing has been working other than that concentrated trade. And that was the time, both in the COVID lows and the great financial crisis lows, whereas if you bought consumer discretionary and some of the consumer names like the VF Corps, like, you know, the Gooses, like the Disneys, you made tons and tons of money. Never bet against the U.S. consumer when they have a job. $6.5 times size of Wall Street. Okay. 13. Yeah, so this is a little sign of some stuff that's going on. 18 months, no stats for investors. I'm not sure what the source is. You've got to put the source here. 6.5 times the size of Wall Street, U.S. asset prices versus Main Street, U.S. GDP at an all-time high. That, again, that's that Buffett rule we talked about and actually disproved because the numerator and denominator have changed based on how much of the earnings come from offshore. So the way that this would be accurate would be if you put this against global GDP and the number would be a lot different. So that's not really a good stat. 37% of equity holdings as a percent of U.S. household net worth, record high. Okay. 25 trillion U.S. tech sector market cap, bigger than Europe, Japan, China combined. 3.3 trillion, Taiwan, with their GDP is less than 1 trillion, market cap now greater than China, Hong Kong. Okay. 1.1% dividend yield of U.S. stock market, matching record low in 2000. So again, a lot of similarities to 2000 if you're overweight NASDAQ and tech stocks. A lot of opportunity if you're looking for more defensive plays that are out of favor. And here is the data. So I guess this is from Bank of America. Yeah, and the highest since the 2021 peak right before you had a correction in 2022. China EPS to grow 13.3% in 2026, very positive. Here's mortgage rates. Earnings growth in Mag 7 has picked back up, but everything is picked up, so that does bode well for the everything trade. And at least a cooling of the AI trade, if not like a resting, it could consolidate. You know, you can correct in time or price. You can just grind sideways for a while, kind of like we've seen with housing since 2022. A lot of grinding sideways, consolidating, et cetera. But now you're starting to see markets go down. 12-month forward PDS. Okay. Household wealth. Risk appetite indicator obviously stretched here. Atlanta Fed GDP is now 4.3, 4.4. So there's some rhyme to the reason. S&P Global Manufacturing PMI, we had been talking about that since 2025. We said this would turn positive. It has. That bodes well for the everything trade once Iran gets wrapped up. Okay. This is S&P total call volume notional 2.6 trillion off the charts. This is meme days, AMC, GameStop, etc. Van's annual revenue is stabilizing. We'll talk about that a little bit more. North Face continues to grow. America's homes, 55 years or more. So a lot of replacement stock, a lot of positivity around building supplies as rates stop going up. Here's the tech to S&P ratio, record, 3 months flows. The herd is all in. Again, that dividend yield, you got to go all the way back to 2000 when you couldn't give away defensives. Pay attention, ladies and gentlemen. Rig count jumps the most since 2022. Very positive for National Oil Well Varco. Although when Iran gets signed, all the oil stocks will be down temporarily. So just get ready for your short-term pullback in National Oil Well Varco, but long-term trend intact. Coming off very subdued levels. Foreign investors likely purchased Chinese stocks in April. If you take that new Fed back to 1914 instead of 1930, you get an average drawdown in the first 6 months of 15%. Renminbi has continued to rise against the US dollar since early 2025. This was key. We were talking about this over a year and a half ago. That'll be the tell when China starts go. You'll see an appreciation of the dollar, just like you did at the peak in 2021 when the renminbi was at record levels. So were Chinese stocks. Chinese property stocks are bottoming. Mag 7 performance dispersion. As you can see, net flat, you've got 3 of them that have done a lot worse than the S&P year to date, and 3 of them that have done better, and 1 of them that's been flat. Market expectations for Fed fund rate have gone up. That'll go back down when the deal is inked. Although the other issue is this is a 60-day deal, so this is going to be like waiting for Godot. So you'll have 60, you'll get it signed, you'll get the violent rotation, and then in a month, and the Iranians are smart. They're doing this basically tying up Trump. So it'll be, let's call it June 15th, it gets signed, July 15th, August 15th. So then they'll be fighting again and negotiating and bombing August 15th through October, right before the election, which will not be good for Trump. So it's kind of a mistake he could also defer it at that point past the election, which he probably will, but something to keep in mind there. Real average hourly earnings have actually been dropping. Not good for Main Street. Let's see if that picks back up. You had a similar situation in his first term before they rose a lot. U.S. equity issuance starting to go up. These new offerings, SpaceX, doing $18 billion of revenue, losing $4 or $5 billion of cash, offering at 100 times sales. Anthropic, OpenAI, all these. There's, multi-trillion-dollar raises, probably raise $250 billion of cash. That's got to come from somewhere. So we'll see what the source of funds is going to be. But that may ring the short-term bell. We shall see. Money supply offers little tendering for inflation. So the argument that they're making here is that money supply hasn't been growing fast enough to worry about aggressive inflation. I think that's true, provided Iran gets tied up shortly. Upward pressure on yields across the curve. Here's consumer sentiment. Again, you can see lowest levels going back 45 years. And that's historically been the time to buy the everything trade and buy the Main Street trade. So keep that in mind. Household debt service ratio is still the lowest in decades, which is debt payments as a percent of disposable personal income. S&P weight of top 10 holdings is now 41%. That's much higher than it was even in 2000. Here's an interesting quote. Passive buying is not neutral in today's market structure. Every $1 allocated into the S&P 500 increasingly becomes a pro-growth, pro-momentum, and pro-large cap allocation. Roughly 35 cents of every incremental dollar flows into the Mag 7, 41 cents into the top 10 names, and nearly half into AI-linked exposure. So if you're like, well, I'm not gambling on all these DRAM and semiconductor stocks and getting caught up in it, I just passively index. Well, 50% of that dollar is concentrated in those bets, whether you like it or not. So if you don't have someone picking the right stocks for you, when that unwinds, you're going to get disproportionately hurt. S&P 500 quarterly EPS seasonally adjusted, going up. Boy, we got a lot of good stuff this week. Residential renovation as share of private construction spending now up to 25%. You haven't seen that since 2011, which is kind of normal. People weren't buying. There wasn't credit availability back then. And now mortgage rates are a little too high. Prices are a little too high. So now they're investing in their own homes. Semiconductor prices are a leading indicator of manufacturing activity. Okay, we covered the AI. Best record on AI powers momentum's best run on record. You haven't seen a move like this since the top in 2000. Hyperscalers, it was a, quote, good quarter for other income. That other income is actually distorting the earnings because it's representative of their investments in these three companies that are going public. So they have equity investment in Anthropic. So it's not like earnings, operating earnings, that the business is healthy and they're getting a return on their invested capital. They're getting a return on their equity investments, not their operating investments. And that's something that is going to be interesting to watch. Margins outside tech are trending higher. This is from Compound Chart Kid Matt. 13.4% net profit margin. S&P versus peak oil. In every case since 1970, once a major rise in oil prices peaked, the S&P 500 did suffer a period of turmoil. Sometimes a bear market occurred, and at other times, once oil prices quit rising, the stock market simply trended sideways and struggled for a period. That would be an interesting base case, because you could have a situation where the everything trade, you get, these moves like Hormel and others that can double in a short period of time, while the AI trade does nothing and the indices do nothing, but a lot of money is made under the surface. And I think we could be entering a period that looks a lot like that. Equal weight S&P divided by the S&P 500. So you can see here down at extremes like you saw in the 2000 peak again. Here you see price outpacing consensus forward 12-month EPS in the semis by the widest margin in a while. Case-Shiller U.S. National Home Price Index is now the most subdued it's been since, I guess, when it came off the peak in 2021, and then going back to 2006, and then going back to 1990. Let's run Mac charts just showing how cheap healthcare is. Another one, healthcare relative to energy, healthcare. So that's the story. We covered the Slumer stuff. This is a great art. My friend Bobby sent this over from JP Morgan. Is AI a job destroyer? Here's what you need to know about AI and labor markets. The key three takeaways: AI disruption is inevitable, but fears of AI-driven mass unemployment are overstated. Three constraints will shape the AI transition: model limits, infrastructure needs, and regulatory, organizational, and socio-political resistance. And semiconductor data center and electricity grid bottlenecks create investment opportunities for firms building the AI's infrastructure. So it just shows throughout history how they displaced on average a few 100,000 jobs a year. People are now saying AI is going to displace 10 million. And this article says, well, that math doesn't sync because we only have 25 million GPU chips. You would need 50 million GPU chips to displace 10 million jobs. Oh, and by the way, any task that is like more than a certain number of hours, the success rate of AI goes down to 50%. And when you consider the average wage of a human that can do it being $50 an hour or $75 an hour, it becomes cheaper to keep the humans, and the cost of tokens and blah, 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 blah. So it just covers all the puts and takes, and then also acknowledges what we've always said, which is that it'll create a tremendous amount of new industry, which will create new jobs. And it goes through periods like in 1930, the influential British economist John Maynard Keynes warned that the economy would, quote, be afflicted with the disease of technological unemployment. In 1964, an independent commission urged President Lyndon Johnson to adopt universal basic income to mitigate the impact of technological change. In 1983, Nobel laureate Wassily Leontief argued that human labor would be eliminated as horses were when the tractor appeared on the scene. If investors had taken these warnings as signals to sell risk assets, they would have made a catastrophic error. We agree. AI is going to help all of these standard businesses increase their margin, increase their productivity, which will be disinflationary over time. Hormel tops quarterly estimates on strong demand for protein-rich foods. That's been our core thesis since day one. Revenue was up 2.4% year on year. We'll cover this one in coming weeks. Gross margins were up 7% year on year. They generated $75 million of, free cash flow of $97 million. They've got $827 million cash on the balance sheet, up $156 million, paid down some debt, returned $161 million to shareholders via dividends. This was the 391st consecutive quarterly dividend payout, and they've increased the dividend every year. Dividend aristocrat for more than 65 years. Reaffirmed their guidance, and management believes trending toward the upper half of the earnings range. So they're sandbagging it on the low end, so they're going to beat and beat and beat. Alibaba's new, and you couldn't give the stock away. So that's changing. Alibaba's new AI model scores higher than OpenAI and Google rivals in coding ranking. China is moving quickly to instant retail, which is all about Alibaba. AI super apps are remaking China's internet. Again, all about AI, Alibaba. China lets policy loan rate fall to record low to boost economy. All about Alibaba. Appeal of China assets keeps rising among global investors. JP Morgan research says Alibaba being the biggest weight. China EV exports worldwide rise 40% year on year to 278 in April. Cooper Standard does tremendous business over there. Cox Automotive forecasts new vehicle sales pace in May expected to increase as buyers shake off high fuel prices, low consumer sentiment. Cooper Standard. Europe car sales rise for third straight month on EV demand. Cooper Standard. Cooper Standard makes more parts per vehicle and higher cost per vehicle on hybrids and EVs than it does on ICEs. Our whole base case when we initiated the position at $5 and change was predicated on ICEs. So this is just adding more and more margin to the bottom line. When we hit peak cycle, 17.5 million cars, you're going to see this business earn $10 a share and trade at a 10 to 20 times multiple, 10 being trough, 20 being peak. You can do the math. It's going higher. Honda will now make hybrids the core of its business. Again, that helps Cooper Standard. Jeep and Ram parent Stellantis to launch 9 new vehicles under 40,000. We talked about that when Cooper Standard was $5. I said, if these companies don't start making calls, they had this monopoly where they could control the supply of the big cars and charge over market, charge $120,000 for an Escalade by keeping them scarce. I said that gig is going to be up if they don't start producing cheap cars for regular people. Hyundai and all these others are going to come in and flood the market. That's what happened. Now they're catching up. You're going to see inventory levels go up, which is beautiful for us, bad for them. And you don't need to be a rocket scientist to do well in investing. Like, these patterns are so predictable if you just take the time to study history. Here's the defensive stock market trade that works no matter where bond yields end up. And this is from Barbara Kohlmeier, who, by the way, I think it was her who put me on the map March 18th, 2020, when the Dow was down 33%. And we said, look, no one knows if we're going to get a vaccine or when we're going to get a vaccine. But in 1918, the Dow was down 35% during the Spanish flu. They had less visibility than we have with the Dow down 33%. We're going in the market. We're buying their generational buy. If the world is coming to an end, we don't have to worry about our stock portfolio. If it's not, we're never going to get a chance to buy these businesses. Next day, market was down another 6%. Day after that, they backstopped the corporate credit market. The market turned up, never looked back. And it was just, so anyway, Barbara picked up I think it was Barbara who picked up the article from hedgefundtips.com, put it on Market Watch, and many people saw that and forever grateful. So now she's talking about buy defensives. God bless her. I know she reads our articles, gets our articles every week. Whether she reads them or not, I don't know. I don't call her and ask, but she's right on it here with defensives. This is where you're going to make a ton of money. All these things that are out of favor, you get paid to wait. And when they turn, it's going to be game on overnight. So kudos to an incredible article by Barbara. AI capital spending boom looks historic. 11 other booms suggest a bust is inevitable. This is from Steve Goldstein, who's also quoted me a lot on Market Watch. And he's just talking about busts occur when capital spending starts declining, which could be from rising financing costs, overcapacity, asset price reflexivity, cash flow delays, or any combination. Their expectations AI will meet the same fate as post CapEx booms. It's hard to find any example of a capital spending boom as large, fast, narrow, and privately funded as AI spending has been. That hasn't ended in a bust period historically. The question is timing and catalyst for the boom turning into a bust. Of note, capital spending busts do not mean that capital spending was worthless. All the capital spending booms we looked at were incredibly helpful to the economy when looking at the economy over a time frame of decades. Even if the bust causes recession initially, whether the capital spending boom will be beneficial to equity credit is separate from whether the capital spending boom is helpful to the economy long term. We agree. We saw it with the internet. Internet changed the world, created all these new industries, influencer industries, et cetera. SaaS companies. I mean, so many jobs. Like, people think about this SaaS apocalypse. 20 years ago, there weren't millions of people making $500,000 programming for SaaS companies. That was largely a function of all the investment made during the internet boom, laying all the fiber, et cetera. So net, our standard of living is going up from all this CapEx. Do you want to be the debt that's financing it or the private credit? Probably not. Do you want to be buying it as if it already happened, paying, for cash flows that'll come 100 years from now? Probably not. But do you want to be a human being living on Earth right now and benefiting from all this stuff? You bet. You bet. Beware the boom and bust cycle of memory stocks. Investors warm amid AI excitement. Chip rally is at 5.7 trillion and counting. How much farther can it go? So it goes through all these historical examples. Goldman traders see a short squeeze brewing for unloved sectors. Total bearish positions across U.S. and Canadian equities surged nearly 100 billion to reach 2.13 trillion, an all-time high in data tracked by S3 Partners. The median short interest in the S&P index stocks has climbed 3% of market capitalization, highest since 2011. The concentration of bearish bets could create a mechanical unwind for equities as investors forced to unwind short positions must buy back equities to repay for those trades. So it's record short interest on the everything trade against utilities, consumer staple groups, etc. And then record call buying on the AI trade. And you want to be the opposite side of both. You want to be long staples, lightening up on the AI trade. And these extremes always go a little bit further, but the more they overshoot, the more violent the rotation is when they finally turn. Don't count out the consumer or consumer stocks yet. That's from Teresa Rivas. Sectors worth investors' attention. We couldn't agree more. And we've covered those names. Estee Lauder, consumer name. Ends acquisition talks with Spain's Puig. Stock's been up on that. That's fine with us. Mandalorian and Grogu tops box office as Disney bets on Star Wars revival. We like the new CEO. Oil rig count up by most in 4 years amid drilling recovery. National Oil Varco. U.S. manufacturer expands the most in 4 years on stockpiling rush. Again, this is going to be good for the everything trade. Over half America's largest cities are seeing home price declines. We said that was coming to a theater near you. It's happening. Affordability going up. Now all we need is rates to go down. You'll see a lot of supply come on the market. Prices will go down more. Housing boom will be back. Building will be back. The game will be back on. Hassett says ending Iran war may create room for a Fed cut. You think? 100% we agree with him on that. Tencent links PayPal to WeChat Pay network, enabling U.S. users to spend across China. I think that's going to be a bigger deal than people think. Dentsply Sirona expands distribution partnership with Nashville Dental. That's like the 5th re-signed distribution deal. They're going to turn that one as well. And thank you to everyone who gave us the opportunity to buy more shares. Boeing wins FAA approval to ramp up 737 MAX production. Boeing CEO says 200 jet China deal is an initial tranche with more to come. That's great. Let's see what happens when the stock gets back up to 300. Why ready to drink cocktails keep growing in 2026. That's Diageo. Papa John's to open Pizza Planet pop-ups in LA for Toy Story 5. This was their playbook when they were booming in the past, doing a lot of these toy partnerships. They're back to the basics, and they're going to make it work. Full tank of tailwind, stock market, and sentiment results. This is our article of the week. Starting with Cooper Standard. For newer readers, here's a quick overview of the key drivers behind our thesis on Cooper Standard. Special situation auto supplier offering a leverage play on the light vehicle production recovery and the massive operating leverage that comes with it. So we were buyers, initiated the position in May of 2022, went public with it on the Clayman Countdown June 6th, 2022. And it's been a great stock for us, and it's just getting started. Here are some of the key things. Same story, different quarter. Cooper Standard delivered another quarter of textbook execution in what only can be described as a brutal operating environment. Tariffs, the Iran war, rising input costs, customer supply chain disruptions, anemic production volumes, the headwinds stacked against Cooper Standard are among the harshest the auto industry has faced in decades. And yet, the only thing that mattered this quarter was that Cooper Standard kept doing what Cooper Standard does best, cutting costs, driving efficiency, and executing. On that front, the countless headwinds have done little to derail the company's steady operational progress, a credit to management's discipline and ability to execute through an extremely difficult backdrop for the industry. Revenue of $686 million was up 2.9% year on year, beat consensus by 4%. Gross profit came in at $82.4 million, up 6.8% year on year, with gross margins expanding 40 basis points to 12%, bringing the two-year expansion to 290 basis points from the 9.1% level in Q1 2024. Fiscal 24, adjusted EBITDA totaled $51 million, beating consensus by 6%. Margins came in at 7.4% versus 8.8% in the prior year, though the entirety of the year-over-year decline was driven by non-recurrence of a $10 million one-time royalty payment received in Q1 2025. Strip that out, and both adjusted EBITDA and margins would have improved year over year. Most importantly, CPS remains firmly on track to achieve long-awaited return to double-digit EBITDA margins this year, along with fourth consecutive year of positive free cash flow. In fact, management explicitly stated that CPS is on track to achieve or exceed full-year guidance, with a formal update expected alongside Q2 results in August for a group of conservative Midwestern operators that say that after Q1, the writing is on the wall for a guidance raise. And they're doing all of this with zero help from production volumes. But the real story this quarter, and what should not be glossed over, is that Cooper Standard's net new business awards have, as Jensen Huang would say, gone parabolic. CPS booked $127.9 million in net new business awards during Q1 alone. To put that into perspective, that is more than 70% of the total awards won in all of fiscal year 24, $181 million, more than double the amount won in Q1 fiscal year 25, $55 million, and annualizes to $512 million, well ahead of management's $400 million target. Of the $127.9 million in awards, 31.8 was tied specifically to battery electric or full hybrid platforms, which carry 80% cost per vehicle extra and 20% cost per vehicle versus ICE, respectively, continuing the secular mix shift toward higher content programs. Even more impressive is the fact that 85 to 95% of the business launching in 2027 and 2028 is already booked. Cooper Standard already knows the pricing, expected costs, and required investment for the overwhelming majority of what will launch over the next several years. Cooper Standard has the capacity to bring this new business online with minimal incremental capital investment. The key reason management continues to guide for ROIC tripling to above 20% by the end of fiscal year 28. With the refi overhang now behind CPS and no material debt maturities until 2031, the focus turns to the biggest needle mover in the story, which is volumes. On that front, despite the market's fixation on short-term noise, the bigger picture is still being driven by secular trends and catalysts moving decisively in Cooper Standard's favor. Millennials' prime ownership years, now the largest generational cohort at 21.81% of the U.S. population, with 74 million entering prime vehicle ownership and family formation years. Record U.S. population. The U.S. population now stands at 343 million people and continues to grow, providing steadily expanding demand backdrop. U.S. SAR sitting well below prior cycle peaks at U.S. SAR at 15.9 million today versus 17 to 18 million plus in every prior cycle going back to the 1970s, despite a population that is now far larger. Record high average vehicle age of U.S. passenger cars on the road at an all-time high of 14.5 years, up from 8.4 in 1995, driving structural replacement demand. Strongest licensed driver growth in 40 years. U.S. licensed driver growth pacing at 11.7 million over 2023 to 2027 estimate, the highest five-year growth bucket since the 1970s. Depleted domestic inventories. Inventory to sales ratio sits at just 1.3 months, well below the long-term historical average. Improving affordability. Cox and Moody's Vehicle Affordability Index now sits at 35.2 weeks of income needed to purchase a new light vehicle, down from the 42-week peak in early 2023. Rising incentives. The industry incentives sit at 6.9% today versus 9% to 10% long-term average. Plenty of room to work higher. Ford nationwide employee pricing. Ford, Cooper Standard's number one customer at 27% of revenue, rolled out employee pricing on most 2025 and 2026 models, providing a direct boost to volumes on Cooper Standard's largest and highest cost per vehicle platform. Chinese OEM expansion accelerating. Chinese EV exports rose 40% year on year to 278,000 in April, with Chinese OEMs continuing to gain aggressive global market share. CPS expects to triple sales to Chinese OEMs over the next 5 years. Jeff Edwards summed it all up best on the call. Quote, "I'm still bullish because I believe that the overall macroeconomic environment is positive. I think the geopolitical environment has to become more positive. How could it be worse?" And so that's the reason I believe the second half potentially has some tailwinds to it. Bottom line, Cooper Standard continues to execute on every lever within its control while waiting for the cycle to turn. When, not if, volumes normalize, the operating leverage embedded in this business is set to be massive. With $3.8 billion in revenue and 14% plus EBITDA margins on the table by 2030 versus the 2017 peak of $3.6 billion in revenue at 12.5% EBITDA margins, that drove $7.20 in EPS and a $146 stock price. The path to $10 plus in earnings power is no longer a someday story. It is now a direct line of sight. So we highlighted all the key things in the earnings report, deck, and conference call, and then you can go to hedgefundtips.com and read the 10 key points. Moving on to our next story of Advanced Auto Parts, which also crushed it. Again, we have our key drivers behind our initial thesis on Advanced Auto Parts, the long-neglected auto parts retailer undergoing a back-to-back basics turnaround with substantial margin recovery still ahead. Right part, right place, right time. That is finally what Advanced Auto Parts is delivering. Advanced Auto Parts shot the lights out in Q1, posting its strongest comp sales growth in 5 years at plus 3.5%, while expanding adjusted operating margins 410 basis points year over year to 3.8%. The print was a welcome surprise that bucked the prevailing consumer doom and gloom narrative, sending shares as much as 20% higher following the release. Shares have now nearly doubled from the lows reached when the business was priced for death, as the market slowly comes around to the reality that operational overhaul under CEO Shane O'Kelly is translating into tangible results. The simple truth is that AAP was neglected for so long that the fixes didn't require reinventing the wheel, but rather disciplined execution and a return to basics. For an auto parts retailer, that means having the right path in the right part in the right place at the right time. After years of operating with an inefficient supply chain that routinely failed to accomplish that fundamental objective, Kelly and the team ripped off the Band-Aid and got to work. AAP has reduced its bloated distribution network by more than half to just 16 distribution centers, adopted the hub and spoke model used by best-in-class peers O'Reilly and AutoZone, expanded SKU assortment to more than 100,000 products, and tightened in-store operations with employees behind the counter who actually know auto parts. These long overdue changes are beginning to deliver exactly the kind of results one would expect. Parts availability has improved from the low 90% range to the high 90% range. Pro delivery times have fallen to under 40 minutes, and AAP is finally moving up the call sheet for customers in need of parts. Those operational improvements were the key driver behind both DIY and pro channels posting accelerated transactions and units per transaction in Q1, with DIY returning to low single-digit growth and pro delivering mid-single-digit growth. More importantly, Main Street Pro segment, Advanced Auto Parts' number one focus as it pivots away from lower margin national accounts, outperformed the broader pro business by more than 200 basis points. These improvements are also supporting an operating margin recovery that is only beginning to come off the mat. After bottoming at trough levels at just 0.4% in fiscal year 24, the weakest in more than 20 years, the number one metric in the AAP turnaround still has plenty of runway ahead as margins work their way back towards the company's historically high single-digit range. Management continues to expect full-year operating margins in the 3.8 to 4.5% range, with the midpoint implying 165 basis points year-over-year expansion, with at least another 100 basis points of improvement expected in fiscal year 27. 5.2% at the midpoint. Advanced Auto Parts is on track to reach its medium-term 7% target by what increasingly looks to be a fiscal year 28, a very manageable hurdle that still leaves it well below the high teens operating margins consistently generated by best-in-class peers. But as we like to say, the key to happiness is low expectations, and the implications of even a return to high single-digit operating margins are massive. On $9 billion in revenue, 7% operating margins would translate to $630 million in operating income, a level that has historically supported well over $6 a share in earnings power and a stock trading north of $150 at the low end. After multiple false starts in what the market has long viewed as a never-ending turnaround, consensus remains largely on the sidelines in the show-me mode, sitting at around 5% operating margins for fiscal year 27 and 5.6 for fiscal year 28. We are more than happy taking the other side of that skepticism, with the supply chain, merchandising, and executional overhaul under O'Kelly being exactly the medicine the doctor ordered. For a closer under-the-hood look at the turnaround strategy being executed and why the numbers are just beginning to inflect, the recent interview below with Shane O'Kelly is well worth a listen. We've here highlighted the key results from the earnings call and top 10 key points. Go to hedgefundtips.com to review it on your own. Fear and Greed at 61. National Association of Active Investment Managers has been taking some off. And that's that. Our next opening for the smaller accounts will be on July 1st, and the minimum will be 1.5 million at that time. Opinion, not advice, not a solicitation. Communication services top 30 weights, earnings revisions in the last 60 days, up 1.7% for this year, down 0.58% for next year. Tech revisions up 9.8% for this year, up 22% for next year. Insider buying in Boeing, one of the directors bought $300,000 of shares. Same director who didn't buy last year at $135, but that's okay. He left more for us. Earnings knocked it out of the park. We already know that. And now we've got a lot of awesome Ask Me Anything questions from our audience, and some to even catch up from last week as well. So let's get started. Jasper J, any thoughts on shorting MRAM? We don't discuss shorts publicly. Tom, love the podcast, but I think I couldn't be clearer on our views of certain sectors over the last hour and 9 minutes. Love the podcast. Been following for 4 months now. Very pleased with Generac and VF Corp. What are your thoughts on the fact there are ever-growing number of passive investors out there and less price discovery like Great Hill Capital is doing? Is this impacting the voting machine and or the weighing machine? No. No matter what, I think the net effect of AI is going to be less opportunity for people with a short-term mindset because the computers are going to arb you out, and greater opportunity for people with a long-term mindset because what's down will stay down for longer, but when it turns, it'll be more abrupt because all the computers will start to chase all the same things at the same time. So rather than getting a linear path of price discovery, it'll be like this and then like that. And we like that environment, and that's going to make us a lot more money over time. Kyle M. He's trying to get complicated about consumer sentiment. Just buy consumer stocks. Don't overcomplicate it. Sean Rogers. Is there anything other than PE and a buyout plan that has you bullish on payout? Neither of those are part of my thesis. Go back to the articles. We talk about every division in the business. Margins are reaccelerating, record revenues, record free cash flow, record execution. And yes, they're buying in 15% of the stock. So my share of the pie keeps getting bigger without putting new money, although we are putting new money every single day. So that's that. Comstock, not trending. Are you concerned? No. We know what the proved and unproved reserves are worth, and they are worth meaningfully more than where the stock is trading at the moment. And we've been buying more. So thank you for selling me your shares. Mike says, Tom, he's asking about cash on the balance sheet for the hyperscalers. What matters in terms of financing $1 trillion of commitments is what's your ongoing free cash flow. And in their case, it's going negative by Q3 in aggregate for the hyperscalers. Long-term energy thesis. Yeah, you cannot value company in the oil business the same way you value a company in the tech business. So he's talking about Comstock had negative cash flow. The value of you're valuing the business on the basis of reserves relative to the price. So Boone Pickens used to have a saying that the cheapest place to buy oil wells was not in the field, but on Wall Street, because when the voting machine becomes despondent on the industry, you can buy them at such a deep discount to the intrinsic value of the reserves, and that's what we're doing with Comstock. Davis Long, blah, blah, blah. Okay, so this guy's saying, why not chase Korea? Because it's up on the semiconductor trade instead of buying Alibaba for your emerging market exposure. And the answer is because that business is going to get shellacked very shortly. John H. Is asking about Newell. Newell is not for us. It's too levered. I know they're paying down debt. I know they have a plan for a turnaround. That lady who came before the CEO destroyed it so much. It's going to be a heavy lift to turn it around. Not impossible, but not something I want to be involved in. Nomad Foods, I'm not comfortable enough with the brands. Financially, it looks okay. I've looked at it a million times. Beyond Meat, are you joking? Like, who eats that shit anymore? I mean, John, come on. All right. Alejandro Bustamante. I remember meeting one of the CEOs. I don't know if it was Beyond or the other company, the dog meat company, whatever it is. And we were in the green room, and he was all excited about his plant burger, whatever the hell it is. I said, listen, if it's so great, because his stock was down 80%, I said, if it's so great, why don't you just do what Pepsi did in the 80s and do a blind taste test? Crickets. No interest in a blind taste test. Stock went down another 50% from there. So tells you everything you need to know. Malibu Boats, or Industries, or Winnebago. Just watch rates. When I like Malibu Boats when rates go lower. So it might be the time to start to look at it. Same with Polaris, same with all of them, anything related. Camping World, that one got destroyed. That was, what's his face's company? The Fixer. And hasn't worked out, but I mean, it's been a tough environment for all the recreation stuff. I would probably look at Malibu Boats if you start to see rates coming down meaningfully, but I'd rather play rates on housing and cars. Danny Callahan, MZTI. Marzetti Company. Learn something new every day. What's this? What do these guys do? Manufacturing and marketing of specialty food products. Food service. So this is like a mini Cisco. $18.96 Westville, Ohio. I kind of like this one, to be honest with you. MZTI. Record free cash flow, record revenues, decent return on capital, decent multiple, low debt, reasonable share count, stocks down almost 50%. I think it's worth doing some work on. I'll write it down. Good work. Who's this guy? Danny Callahan. Good job. Armin S. How come you favor Hormel over Campbell's? Because it goes up, not down. So no, it's different brand composition. It's protein based. It's in line with GLP-1, better management, better balance sheet, better free cash flow, better opportunity. I mean, Campbell's, they've worked 24/7 to destroy the business. They haven't succeeded. So they're going to work harder and try to destroy it. But the brands, they've got good enough brands that they're not going to destroy it completely. That's probably, we talked about a basket of those. By the way, that basket is up huge today. We put it out on the podcast when, I told you these entrepreneurs I talked to, they're like, oh, should I be in cash? Blah, blah, blah. It's like, why don't you just buy a basket of these? You'll double your money over 12 years. The dividend goes up. You'll double your income. 30 million becomes 75 million. Your 2 million of dividends becomes 4 million of dividends. And that's a lot better than cash. It's not the way to shoot the lights out, but it's better than holding cash. And that's starting to work. Chapman's asking about ASOS. ASOS, we mentioned on the pod a few years ago. We had a tiny little position. It's not even a big enough position to be in my kid's IRA account, but we've watched it. It hasn't given us any reason to make it a big position yet. And the biggest problem there and why we never made it a real position is the CEO was a consultant, and they tend to be the worst. I'm just telling you from experience, they don't work. That said, he's turned around the free cash flow in the last year and a half. So that's good. He hasn't yet turned around revenues. If I see a turn in revenues, we actually may make this a real position and get behind it. But there's no signs of that yet. But that's why we have a few shares, is to keep an eye on it every day. And when it starts to move, figure out why and whether we want to size into it in a material way. Chris Booker, FLGT. Genetics. We don't do individual biotech stocks, so hard pass on that. Next. Theo Dujardin, congrats on all your great picks. Many positions have delivered again outstanding earnings this quarter. Why is the market? Can you educate us a bit on why sometimes the market's reaction is completely out of sync with the seller results of some business deliver? What drives something reaction? Sometimes it's a sell side. Sometimes it's other exogenous events. Sometimes it's for sellers. Sometimes it's impatience. There's a reason some things are called a mystery, because mysteries are not meant to be solved. I mean, what you need to do is focus on what you can control. And what you can control is, are you paying? Are you getting? Do you have relatively certain expectation of getting back way more dollars in the future than the dollars that you put in today in the form of free cash flow, and then discounting those future cash flows back to the present value and determining whether you get a deal based on your discount rate and whether you're getting more than you pay for. And if we do that over time, the weighing machine takes care of us. And sometimes the weighing machine takes care of us overnight, inside 12 months, which is actually negative, because then you got to pay long-term, short-term capital gains. That's the exception. Sometimes it takes way too long, longer than we expected, which is 5 years, but they average out to about 3 years, and we get our doubles and triples, and we rinse and repeat, and we just continue to do it. So we don't focus on why does the market do this? It's a voting machine. It's a manic depressive. Read The Intelligent Investor by Ben Graham. Short term, it's a voting machine based on emotions. In the long term, it's a weighing machine based on fundamentals. You don't know why the market's being emotional, and spending time trying to figure it out is a waste of time. Focus on what you can control and get your mug and put it on your desk. It says hedge fund tips on the front, and on the back, it says short-term voting machine, long-term weighing machine. So when you see Advance Auto Parts beat and go up 20%, you say, oh, the short-term voting machine. In the long term, it's going to be a $150 stock. Or you see someone, VF Corp give good earnings and the stock is down. Oh, short-term voting machine. In long term, it's going to be a $50, $60 stock. So you don't worry about it. So having a display like this is probably not a bad thing for most of you. All right, moving along. Oh no, I deleted one. See if I can get that out of trash. Where is it? John, deleted. Okay. No. Okay. Well, we'll just get back to it here. Other. Yeah, so this guy's trying to pitch me a biotech stock to make an exception. I don't make exceptions to my rules. That's why I have durability and predictability over time. The reason you guys blow up accounts is because you always make exceptions. It's like, it's like an alcoholic going to a bar. You guys can't help yourselves with these shiny objects. Let it go. Rule number 1 is don't lose money. Rule number 2, don't forget rule number 1. And the only way you'll screw yourself is if you unnecessarily interrupt compounding. Look, I've gone through this a million times. If all you do is compound at 15% per year, you double your money every 4.8 years. So if you start with 20 million bucks, you wind up with $1 billion in 28 years. If you start with 2 million bucks, you wind up with 100 million bucks. How do you screw that up in America, the greatest country in the world, where you can literally do that without curing cancer, without inventing the wheel? You can literally get rich from a modest amount of money if you just keep the discipline to not screw up compounding. And so many people, unfortunately, we're programmed as humans. We have a herd mentality because we like to survive. So you follow the herd. For the most part, you survive. It goes back to survival instincts. And then there are like a few dozen people with genetic defects who, when God was handing out FOMO genes, he never gave us one. And we're able to do this. And you can learn it over time, but you really have to avoid the temptation. And the temptation is always going to get you, because even if you break your rule and you win and you get a 10-bagger on a SpaceX or some crazy thing that's trading at a ridiculous valuation and turns out to be true, you're going to think that it was skill, not luck, just like every gambler in the casino. And what's going to happen is you're going to take that 10x and you're going to take the $1 million that you made in SpaceX and you're going to dump it in the next big thing called Sono that makes music in an app or whatever the hell it is. And you're going to think it's going to go to 10x. And instead, after 5 years of liquidity, it goes to 0. And in the meantime, that 100,000 that you started with that went up 10x and now is 0, went up to $1 million and that is now 0. You could have compounded that and already doubled your money in 7 years in an index fund. Never mind compounding at 15% and do it at in 5 years or more than 15% and doing it sooner. You unnecessarily interrupted compounding by getting tempted by the dark side. So that's that. All right, that's spam email. Mike Gower. Yeah, so Mike is like saying he's got this scenario where PayPal becomes a 10-bagger. PayPal's not going to be a 10-bagger. It's going to be a 3-bagger and we're out. Maybe 4-bagger. Marlon Estrada, all the best for you and your family always. What do you think about Zoetis? Look, here's what you need to know. And I say it every single week. I buy good businesses at great prices. These are not going to be 10 baggers. In the case of Cooper Standard, okay, Cooper Standard is going to be a 20 bagger, but that's the exception, not the rule. PayPal is a good business at a great price. It is not a great business. I have no delusion. I had a meeting with someone about Dentsply Sirona, okay? And, they're trying to like understand how it's going to go back to being the greatest business. I said, what are you talking about? I have zero expectation or interest that this is going to become the greatest dental business again. It's kind of a mediocre, slightly shitty business, to be honest with you, that's going to triple to quadruple my money over the next few years when they just stop bleeding. I mean, when you're so big and entrenched in a business and you provide things that people want and need, even if they're commodities to a smaller, greater or lesser extent, when you price is what you pay, value is what you get. The value of that business, that mediocre, good business, not great business, good business, is probably 40 to 60 bucks. And I can buy it at 10 and I don't have to cure cancer. And all I got to worry about is solvency risk, which I'm pretty comfortable with. Who's the jockey, which I'm very comfortable with. And what do they sell? And is it cyclical or not? And where are they in the cycle? They're in the trough of the cycle. They're turning. Some of their peers have turned a little bit faster, probably grabbed a little share from them. But the margin of safety is big enough that I want to have a big position. And our position got a lot bigger this week. So do I need it to be the greatest business in the dental industry? No, that business is probably private and my friend runs it. But do I need it to be slightly better than now and catch a little bit of a sectoral tailwind and an industry tailwind, and the operating margin creates enormous operating leverage and I get a 4 or 5 bagger? That's all I'm looking for. PayPal's not going to be a 10 bagger. That's fantasy land. Okay. Maybe, if they catch a thing on stable coins or Venmo, but that's all bullshit. Be happy with a triple over a few years with surety that you can put in decent size and on to the next. So that's my 2 cents for this week. Zoetis. I think we covered this one last week. I don't like animal health. It's cheap enough that I don't think you're going to get hurt, but it's not something that I'd love to be involved in. I mean, the financials look great, but, animal health is where money goes to die. I don't know why, but it just never seems to catch a run. So this thing's broken. It's going to take a lot longer to fix than you think in terms of price, but this is the short-term voting machine, because based on the fundamentals, I'd say you should buy now. Based on just experience, I think it's going to take probably 1.5 to 2 years to find a base, and you probably start finding buyers around 60. So even though that's unrelated to it's a broken growth stock. So let it alone for a little bit, let it breathe. If it runs away without you, move on. But animal health is just not the spot. Why is PayPal's not a payment option on the HFT shop? Fourth wall is just like where people like me who are not trying to make money off of their stuff post their stuff, because they drop ship it, they make it, they ship it. My assistant can go in and write in a quote and they put it on a mug and they ship it and they send me $10 a month. And, after they take 90% of the margins, it's just a way to get merch out there so people can share your brand so that you can grow your brand, grow the podcast, and continue doing this for another 7 years. So it's their shop. We don't collect the money. They send us a few pennies on everything, and that's the way it is. If I insourced everything and made that a business, it's not my business. I did it because people asked for it, and when people started referring their friends and family because they saw their mugs and they saw their hats and they saw their shirts, I said, wow, I'm making it easier for people to share this. Let's get it out to as many people as possible. So I don't control that shop. The hedge fund tips site is all run on PayPal. So there's your answer. Good question. Long answer. Albert Ruddle. Carter's. Baby clothes is another place money goes to die. But let's just take a look. Looks like revenues are stabilizing. Share count's down. Multiples low. You could probably take a punt at this one. Hopefully it gets back down to 30. You can pick some up. I don't love this long term, but it's a cyclical business. It's probably okay. I wouldn't bet on it, but I think you're generally right in your reasoning. What's the debt? It's not bad. Free cash flow is, yeah, you'll live to tell the story. I think you're okay there. Benjamin, but it's not the highest and best use. Benjamin Webb, love the podcast. Made some money. Nintendo. Yeah, these gaming stories are not my bread and butter. Not for me. I don't have enough edge. I'd have to understand everything they're selling, how they're transitioning, and I don't. So pass for me, but probably works on a trade. Silvio Tucci. Case Pop is sold. How about getting into Toast? That's an overlap with PayPal. I'm not interested in two payments businesses. Paul Wiley. Paul, if I recall, yeah, I think this is the right Paul. Paul's one of the best putters in Orange County, by the way. Thanks for the time you continue to invest to support the community. Information you consolidate and present in one place. The insights are invaluable. So, wondering your thought on AVAV. All right, Paul. My putting's crushing it now too, by the way. Interesting. AVAV. I don't think it's down enough just looking at it, but let's take a look at the fundamentals. Still negative free cash flow. Huge increase, doubled the share count. I don't like this, Paul. I'd avoid it for now. They probably did a dumb deal, and it's going to take years to absorb. Robotic systems for government agencies, autonomy, blah, blah, blah. So this is a thematic stock. I would avoid it. This is a promote in the short term, and I think you'll have better opportunities to buy it. But good to hear from you. Josh B., been watching for 6 months. Try to recommend it to one person every week, just as you asked. Thank you so much, Josh. That's why this is going to keep rocking. ARRY. All right, let's see. Okay. Thought this was public once before. They must have gone bankrupt and gone public again. Or private, then public. All right, let's just see. This is not really cash flow's been declining. That's consistent with price has been declining. Revenues are starting to perk up. What do they do here? Solar tracking technology products. Yeah, I do think the solar stocks are going to get a bid. I'm not going to be involved in it. Let's see what Enphase is doing lately. Yeah. It's a trade. It's a trade. This is not a business you want to own. So, Josh, that's not what we really do here. But I think you're generally right about instinct. It's not a business I want to own, though. Thanks for all the material. Biorad, we're not doing that. That's an individual. Biotech, Matt Mahler. Wingstop. I have looked at Wingstop. The answer for me is not yet. I know. Cash flow's going, share count. I think the restaurants are starting to turn. You saw it with Starbucks. Oh, man. I think you might be right on this one, partner. Who is this? Matt Mayer. Let's take a look here. A lot of stock-based comp in the last 24 months. Not in love with that, but let's see here. $128 million debt. Yeah, so this is part of the issue is the war yields blew out. They've got a lot of debt relative to free cash flow, so that's kind of your issue there. I think this could bounce on a resolution of Iran as yields come in, so you might find some buyers here. I don't hate it. I think you're okay. I'd have to study it a lot more though to actually put money to work. Will G. Yeah, please. Yeah, I got it the first time. We don't do these type of stocks. Okay, this is what we call. Hold on. Maybe I'm misunderstanding. Oh, it's a lab. Okay. Be more open-minded. Okay, Biorad Labs. Cash flows recovering. Revenues not yet. Share count's coming down. Balance sheet's good. Multiples a little rich. Margins still compressing. What do they do? Life science, clinical diagnostic products. Yeah, any medical instruments, devices have been doing really bad lately. I think this could be probably due for a bounce. It looks okay. I don't think it's the highest and best use, but I think it's okay. So pretty good work there. Next, John Brandon. Usually he's asking what's my favorite child. You know, here's 6 stocks, tell me which one to put all my money in. Like, that is a formula to get you dead. The reason we don't have all of our money in our highest 1 or 2 conviction ideas is because we're humble enough to know there can always be something that you don't know that you don't know. And we operate under the assumption, you know, besides our 2 filters of, you know, if JP Morgan were going to finance me to buy the whole business, I had to be 100% of the equity, 100% of my net worth. And then would the board throw me out if I offered to buy the whole company at the price it was closest in the market? The other thing that we assume is if any, you know, we run a concentrated portfolio, 8 to 12 positions. If any one of these positions went to 0 because there's something that we don't know, would they take me out on a stretcher? And the answer has to be no, meaning the other 7 or 11 positions would more than make up for the deficit and still be able to outperform net of fees over time because of the cumulative expected value. So to answer your question is, yes, you have to be concentrated to outperform, but not so concentrated that if one name blows up from something that you can't know, like there could be accounting fraud, like, you know, shit happens. And there's, you know, that's completely outside of your control. You still live another day. You can still outperform over time. You can still make it back. We haven't had that instance where one goes to 0, but we always operate under that assumption that there could just be something that we don't know. So, which is why we're not going to answer your question, because if you go too overweight on one position, it's wrong. You know, 8 to 12 positions is what we do. GE Healthcare. Yeah, he's asking about Conagra. We covered that a couple weeks ago. I think that's okay for the long term. GE. Probably okay with this one. Healthcare stocks are in the gutter. This one's trading down, reasonable multiple, reasonable free cash flow. I don't think it's a good highest and best use of capital, but it's okay. Yeah, we already updated on the DYNX, DYNC. They notified that they're not moving ahead with the Ethereum, and they gave back investors their investment, and the SPAC traded up on that. So we're no longer involved in that. And I don't think there's any reason to be, unless you want to play the SPAC game and hope they get another deal, whoever the new sponsors are going to be. York Bourgeois, Magnera. MAGN. Medical garments, wire, dryer sheets, coffee bag filters, white filtration, continents. Medical supplies. Okay. $25 million free cash. Got a lot of debt relative to that cash, York. All right, so you got some cash and receivables to cushion you, but your free cash flow is pretty, almost $2 billion in debt. Let's see, what is it? Global leaders. Yeah, I think you hit the nail on the head, York. You're going to have to identify the catalyst. So it's a kind of a commodity business that they're in. And what he's saying is they got flooded with Chinese stuff after COVID. I think you're on the right track with this one. And I actually am going to write it down because I think it warrants more work. Little worried about the balance sheet. I'd like to see if there's a new CEO to maybe turn things. That would be helpful. Someone who's actually turned stuff. But it's amazing how far they've dropped with the share count staying pretty steady. Let's see. Annual. You know, with that much revenue, so they've got some discontinued operations. Yeah, so I think the key here is going to be doing some work on the CEO. I do generally, let me just see, stock-based compensation creeping up a little bit, but that's not terrible. Share count, not bad. All right. I think it's kind of interesting. We got to find the catalyst. We got to find out how the CEO is going to turn it around, listen to the conference calls, but it's definitely worth some more work. Good job there. And let's go to the next one. Pavel asked for H&R Block. This is a dog. HRB. Not for me. I'll just pass on that. It's not down enough. Albert Ruddle. B&G Foods. I don't like this one. This is a value trap. They're selling off Jolly Green Giant. All right, BGS. Yeah, I mean, not only is their business deteriorating, but they keep increasing the share count. I don't like people like that. So it'd probably work as a trade. I understand why you're interested in it. It's just not a good ownership business. Oh, he's asking about Thule, the thing that goes on your car. THULE. Yeah, it's just stagnated. It's definitely worth doing some work on. It's not going to be a huge winner, but it's okay. It's down a bit. Again, you got to go through. It's a little bit levered too. Let me just take a look at the balance sheet. Yeah, that's kind of your issue. Balance sheets a little bit over levered, but I'd have to understand the business more if it's exclusively just those things that go on the roof or they do a ton more. Let's take a look here. Roof boxes, roof racks, bike carriers, rooftop tents, windbreakers. Yeah, they have a nice franchise. I just don't know where the growth and optionality is going to come from, but I think it's okay. That's not something I'd invest in here, but I think you'll probably make some money. Nathan, BBW. Build-A-Bear Workshop. No. Pass. Welcome to the podcast. Nate Zom, Bloomin. Yeah. I looked at this one a million times when we were looking at restaurants. It's probably going to work when they all work. There was some issue with it, whether it was the CEO, but they're all going to get bid. I mean, revenues haven't grown in over a decade. Margins continue to compress. They bought in shares. It's a little over levered, but I think it's going to work. It's just not what I want to own. Outback, Carrabba's, Bonefish Grill. There's some issue with this one, though. I think it was the CEO. Let me just see. Who is the CEO of Reds? Yeah, he was executive vice president, COO of Delta Airlines, then Six Flags, then PepsiCo. Like, this is not someone I want running a restaurant business. It was the same problem with Applebee's. They had a real estate guy. Not what I want. So for that reason, I'm out. It's going to work as a trade, though. Bobby Markel. Yeah, he's saying if tech and software is going to take a breather, won't that hurt PayPal? PayPal is going to trade with software and financials, and I think both are due for a bounce. Marlowe, Cadiz, but that's irrelevant relative to prices, what I pay, values, what I get. That's all short-term noise. You only speak about selling at intrinsic value and euphoric valuations. Do you ever sell something before intrinsic value because there's a better opportunity in the market? If you're fully invested? Generally, no. Aaron, Oda, we know where we're getting out before we get in, and we tend to stick to that discipline, and that's worked well over time. Where would you suggest parking cash between deployments? You earn, congrats on raising girls. Thank you so much, Aaron. In Interactive Brokers, you get paid some interest. You could put it in a T-bill ETF or buy T-bills, but we tend to get invested pretty quickly because when the market's euphoric, defensives are cheap. And when the market's dislocated, everything's cheap. So we always have something to do. Eric Camus. Asking about Comstock, we already answered that. They have the best value per dollar in terms of proved and unproved reserves in the sector right now, to answer your question. Alejandro Bustamante, Lovesac Company. It's a furniture play. I've looked at this one a million times over the years. Let's see what's going on with it now. Furniture is just getting destroyed. Yeah, what's the other big public furniture companies? No, let's see. Lazy Boy, Miller, no. There was another one that I like better. Lovesac is too nichey for it's too much of a niche business. Looks like they're turning a corner here. I think it'll probably work for you, but it's not one we would invest in, even though I think it's going to work for you. Seamus Coleman, AMN. Like to see a little inflection in the revenues here, but they are inflecting. Okay. It's kind of interesting. What do they do? Technology-enabled healthcare workforce solutions. Offers travel nurse staffing, labor disruption staffing, local staffing, rapid response, rehab clinics. Yeah, this is a tricky one because yeah, I just got pitched on a couple of these things in the private markets. I don't do privates. I put all of our net worth in our own strategy alongside clients, but staffing stuff is tough. I mean, even if you look at Robert Half is the best in class, and I I keep looking at these staffing companies. I can't get comfortable around him, but I think it's going to work for you. So I would say go for it. But I just that goes in my too hard box. I think it's going to be fine. Dennis Amato. Small cap. INGN. They're increasing the share count and they're still cash flow negative. That's an easy pass for now. Jacob M. NVO. Bring it up every single week. I think that one will probably work, but not for us. Batahu Han. QXO, would you consider growing your position? We did. Alexis Policarpio. Thoughts on Danaher? Yeah, I like this business. It hasn't gone down enough for me to get the IRR I would want, but I think you're probably okay buying it here. Daniel Melly, yeah, South American Amazon. No, not enough dislocation for us. Lee Foster, KBR. KBR. It's interesting. I have to understand the business a lot more, and I'd like to see the price a lot lower, but I think you're early on that one. Drew, Lyft, no. Value Trap. Zach Harrison, McKesson. Not yet. I mean, not even close. There's no dislocation there. Panos, ADNT. Just not growing revenues at all. This looks like a business in runoff. So, all right. So he's trying to do a Cooper standard play. You know, the thing that Cooper Standard has proprietary technology. I'm not sure what's proprietary about their frames, foams, head restraints, armrests. I mean, maybe it's an Irish-based company, but I think value per dollar, you're not going to do better than Cooper Standard in that space. I think it probably works. Nicholas Ruggiero, Whirlpool. We continue to say no. I don't see any turn yet. When it turns, it will turn hard, but It's just not yet. They had to issue stock. I mean, the real challenge with this one is it's not just that it's below the COVID peak, because a lot of these businesses are. It's like it's still 25% down from like what it was doing in 2015. There's some real execution depression, and the CEO coming on and saying this is the worst since the great financial crisis. It's like, then leave. Let's get someone like Jeffrey Edwards, who has had the worst conditions ever and focused on what he could control and turn the business around in hard conditions, versus a whiny little bitch who is complaining about the world is unfair. They need a new CEO is what they need. Let's see, Whirlpool CEO. He's been in since 2017. I mean, what the hell are they waiting for? The stocks, yeah. So this is a buy on a new CEO. This guy sucks. Next. Joshua Martin, Cobalt. They think they're going to put the fire out with the art. They're going to keep the arsonist in to put out the fire. That rarely works. A little bit late on this one. CVLT. There's no sign of margin recovery here. Cybersecurity, no, pass. Mark Goodman, same thing. Cobalt, not for us. Prim and Tree. What's Tree? Lending Tree, no. Prim. Lending Tree, there's no. Neither of those. Welcome to the podcast. Thank you for sharing. Nick Davies. Caring. Is a Gucci story. I mean, this looks a lot like Estee Lauder. It's just a China recovery play. So I wouldn't want double exposure. Gucci, Saint Laurent, Balenciaga, Brioni. I think it's okay. I wouldn't be in a rush, but I think it's probably okay if you take a 3 to 5 year view. I'd like to buy it lower. Ben Raby. iPar Perfumes. I don't really love that business, to be honest with you. Glad they didn't do the Puig deal, but IPAR. Yeah, I mean, it hasn't come in enough for me to get interested, but it's okay. I don't think it'll get hurt over time. I'd love to buy it at 60. I don't think I'll get the opportunity. Not the highest and best use. Luke H. Brookfield. No, we don't buy things up. We buy them when no one wants them. Dylan Cleary, Western Union. No. I know a lot of you guys love that. It's a value trap. Trey, Combi. Trey's asking if my time working as a golf caddy helped me get into the business. No, it just made me realize to study hard in school, because I never want to work with my muscle as an adult, because it sucked. I wanted to work with my mind. It reminded me to work hard and study hard. Let's see. This is Sam. Belgium, got that, and James Cheshire. Okay, so James is just saying PayPal has partnered with Anthropic in order to provide an online course called AI Fluency for Small Business. Anthropic plugin Claude for small business will also launch, and this will be able to connect with PayPal, also tools, QuickBooks, and Canva. Yeah, they're on it. So that's just a feature. And that's it. So with that said, we'll be back next week. Same time, same place. In the meantime, make it a great one. Bye for now. Pause your video player to review our terms and disclaimer. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Great Hill Capital LLC or PPI is not under any obligation to update or keep current the information contained herein. Great Hill Capital LLC or PPI and its respective officers and associates or clients may have an interest in the securities, derivatives, or entities referred to in this material. Great Hill Capital LLC or PPI accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.